We've got Krishnan Sitaraman joining us now.
Right, Senior Director at CRISIL Rating is with us. Krishnan, what do you make of the 81 bonds data, or the news flow that has come in from the government regarding Yes Bank squashing it off? What does it mean for the bond markets?
Yeah, good morning, everyone. Clearly, this is a reality check. And the way I look at it is this is a learning curve, I would say, an evolutionary process in the learning curve towards better price discovery for investors. Clearly, in the past, we've seen these instruments priced very finely vis-a-vis other bank instruments like Tier 2 bonds or infrastructure bonds, which perhaps had not fully factored in the risks embedded in these instruments. Now, the recent development on the write-down is completely in line with the regulatory framework for these bonds. These bonds do have features which have loss absorption capacities built into them. That means if the bank is in difficulty, these can be written down. And that is why these bonds have been given Tier 1 treatment. Tier 1 essentially means quasi-equity or equity-like. So essentially, the market has not been pricing in these risks probably to the fullest extent. And the recent development is kind of a manifestation that those risks can actually come to the fore. And what this means going forward is a more kind of detailed or more sensitized pricing model by which investors will look at these bonds. There would be a familiarization process or a familiarization period for the next maybe few near future. And post that, what probably we will see is a settling down of a pricing situation where the stronger banks would have a more finer pricing for these bonds, whereas the weaker banks would have a more wider coupon differential vis-a-vis their other instruments. And that is in line with what the rating approach that we use as well. For a very strong bank which has sufficient capital or a strong capital adequacy well in excess of regulatory requirements, the differential between these two instruments could be as low as 1 notch, or for weaker banks it could be as high as 3 notch or more than that. So I think this is I would say an evolving situation today, and the pricing framework for these instruments will undergo a change in the near to medium term.
When we just look at these bonds, do you think the appetite for these bonds will reduce quite drastically? Is that something which you are also looking at after this move?
Yeah, that is something, as I said, there will be a familiarization period for these bonds as to how to price these. And the way I would look at it is there would be a near-term situation where some of the issuances may go on hold. But I think as the situation settles down, the market will realize that this is another instrument which a bank has to raise funding and shore up its capital base. So for a right level of pricing, we do see the market kind of being there for these instruments. If you go back to the last few years, if you look at the last 1 or 2 years, what we have seen is a reduction in these issuances from the so-called weaker banks, and most of these issuances in the last year or two have been from the stronger banks. So I think there is some element of realization has already been dawning in the last year or two, but I think these recent developments will take it to the next level.
Are you not at all worried that, this write-down could have some sort of a systemic ramification, a market-wide ramification as well going forward?
See, not really, because the whatever is the development, that is in line with the regulatory requirements. So it is not that it is a new kind of situation which has come in, which is not built into the regulatory framework for these bonds. It's only that this has not happened in the past. There is always a first time for everything. And this, as I said, will be a reality check for investors to kind of bake it in to their pricing frameworks. So what we will see is definitely in the near term a reduction in the issuances of these instruments, but I see the situation settling in over a period of time as the investors look at better frameworks to price these bonds.
Right. Given the fact that we do have most of the mutual funds and institutions, just particularly on the yes fiasco that I'm talking about, that they plan to move court on the back of this decision. Do you believe that anything material would emerge out of that? What is it exactly that you would hope for now, given IndusInd Bank's move as well on the back of Yes Bank?
As I said, given the fact that the decision which has happened is in line with regulatory frameworks, one needs to clearly evaluate as how the situation would move going forward. The only probable disconnect with this, again, this is a draft plan which has come in. It's not a final plan. Comments have been solicited, and we'll have to wait and see what the final plan looks like. The only disconnect that I see is there is no write-down which has been indicated on the equity side, whereas the AT1 bonds have, there is a write-down entailed there. So typically, if you look at the hierarchy in the liability side of banks, equity would be the junior most. The AT1s would be junior, but senior to equity. So what market participants are trying to kind of figure out is to why there is no write-down on the equity, but there is a write-down on the AT1 bond. So that is the only disconnect, and we'll have to see how the regulatory authorities or the adjudicating authorities figure that out. But having said that, the decision is not contrary to the regulatory framework of these AT1 bonds.
Right. How difficult will it be for some of the smaller private sector banks to raise money via this? And does this also mean that a lot more equity issuance may happen from them, or larger size equity issuance may happen from them versus earlier?
Yes, very clearly in the near term, there will be a reduction for these issuances. Market could be adverse, especially for the mid and the smaller sized banks, or the so-called weaker banks where the capital adequacy position, the excess of capital adequacy vis-a-vis the regulatory requirements is not very healthy. So those banks could face a reduction in the demand for those AT1 bonds in the near term. But as I said, I expect the things to stabilize over a period of time with a better pricing framework. So while markets could kind of restart for these banks going forward, but the pricing would be higher. So it is up to them whether they would want to look at an AT1 bond at a higher pricing, or they would want to go for an equity issuances. There definitely could be more chances of equity infusions or equity issuances from these banks as we move forward, because some of them have, if I look at the investors talking to us about some of these banks, I think there is an interest from overseas investors as well as domestic investors in the mid-size and smaller private sector banks.
Krishnan, so much for that. Always good to get perspective from you.